Namaste, good morning. Friends, welcome to revision classes. Revision has some rules. So let's first get familiar with the rules. The first rule is for myself. I have always said that in revision I will not ask question because in no manner I want to shake your confidence, etc. So I'm very confident that I will go by the belief that you are all aware of it. So there is no questions as such in revisions. Okay. Number two, the 4 days classes is planned, though I have Friday as a buffer, but I want to complete it by Thursday so that you are also feeling more confident. And I'm not going to work out in a pattern. It's random, though chapter wise I'm going to revise, but random. In that chapter, there might be a question from salaries. In a PGBP chapter, there might be a question from IFOS, but I'm not going to work in an order. I'm going to work in a random. And third thing, it is only that I have, as I told you, that I will not ask you a question. You can ask me any question, that I'll assure you. And I always, I have said that whatever chapters or what things you want to recollect, please tell me. And a couple of our friends have said, work out give some clarity on capital gains, etc. Okay. Nothing of the amendment is applicable for you. Indexation is very much there for you. So you should be sure about it. But when we come to it, we will do that. And very randomly, I'm picking up these things and working. The intention is very simple. That is, if I am going to work out of 20 hours of revision, okay, this will take you some 10 hours of preparation at your home. So after completing the second exam, law exam, if you come back home, if you look at the revision aspects, you will be comfortable to go and write the examination. Other than revision, what you need to check, I will definitely let you know. So these are all the conditionalities of revision, are the rules of revision with which we are progressing without wasting any time. So can you distribute it? Okay, without wasting any time, let's get into the workings, etc. I'll provide you the Excel also after the end of the revision. Okay, right. My dear friends, we are all aware of the rates of taxation because in various places we need to work out the rates of taxation. Okay, so just to recollect the rates of taxation. Okay, just to recollect the rates of taxation. Okay, we are only worried about individuals here. We are not looking at any other entities. Okay, just to look at the rates of taxation, we are dividing it into old regime, which is not the right word, as I have always told you. Okay, or normal method of taxation, or normal method of taxation. Okay, and assessee is now falling under, if he is silent, if an assessee is silent, he is falling under default tax regime, which is also known as concessional or new regime, which is also known as concessional or new regime. Please understand, if an assessee is silent, you have to work out only under default tax regime or concessional tax regime. In this provision, which is nothing but section 115 BAC, okay, which is nothing but section 115 BAC, okay, they give an option that if the assessee wants, he can opt for normal system of taxation. That section is section 115 BAC subsection 6. So in some question I saw that the assessee prefers subsection 6, which means he is opting for old regime, which means he is opting for old regime. Okay, please understand that. Otherwise, it is only new regime. Otherwise, it is only new regime. If the assessee is silent, he will fall under new regime. Okay, if he wants to choose, he has to choose the old regime. Okay, can you pass on the material? Okay, right. Let's progress. Okay, let's progress. Now, in this regime, the tax rates are, okay, basic exemption limit will be 2,50,000, 3 lakhs, or 5 lakhs, as the case may be. You know what it is. No, okay, less than 60 years old, senior citizen, super senior citizen. Okay, and then the tax rates are up to 5 lakhs. Okay, in all the cases up to 5 lakhs, here it will be not applicable. Okay, it will be 5%. Okay, up to next 5 lakhs, okay, it will be 20% in all the cases, and more than that it will be 30%. More than that it will be 30%. So the basic exemption limit, okay, rates, okay, and income exceeding. So we all know that here it will be 1,12,500 up to 10 lakhs. Up to 10 lakhs, I am saying 1,12,500. Here it will be 1,10,000, and here it will be 1 lakh. Here it will be 1 lakh. These are all the rates of taxation. Whereas if the assessee goes in for the concessional rate of taxation, okay, it will be every 3 lakhs 5%. Every 3 lakhs 5%. Okay, I am very clear. Whatever is the amendment that has been made in July is only for the May examination. We will study that in final. Okay, as of now, forget those amendments. You don't get confused with those amendments. Whatever that has been made, okay, same classroom, in final we will study that. Okay, right? As of now, stick on to the one which we had it in the classroom. Up to 3 lakhs, 3 to 6, 6 to 9, 9 to 12, 12 to 15, and more than 15. So here it will be up to 1,50,000. Up to 1,50,000. Okay, are you understanding? Up to 1,50,000, 15 lakhs, the tax will be 1,50,000. More than that, it will be 30%. Remember, there is no difference between a senior, super senior, or less than 6. Okay, there is no difference here. There is no difference over here. You need to work out in this particular fashion. Okay, in the later classes, in the later hours of our classes, we will try to work out some surcharge questions and see, okay, as to how this surcharge needs to be computed, where we have to be cautious. But the base rates of taxation are this. There are 4 special rates of taxation. There are 4 special rates of taxation. Section 111A, STCG, on which STT is paid 15%. Section 112, General LTCG, 20%. Please don't get confused with the amendments. It is 20% for our examination. Okay. Section 112A, LTCG, on which STT is paid first 1 lakh nil, on the balance 10%. Okay, lottery income 30%. There are 4 special rates of taxation which I need to remember. 4 special rates of taxation. Having said this, I also want to tell you that if my income taxable at normal rates is less than basic exemption limit, if my income taxable at normal rates is less than basic exemption limit. Suppose my total income at normal rates comes to 2 lakhs. My total income at normal rates comes to 2 lakhs. My basic exemption limit is 2,50,000. So this difference is known as, okay, this difference is known as deficit. This difference, deficit, is the difference between basic exemption limit and income taxable at normal rate. Deficit is the difference between basic exemption limit and income taxable at normal rate. This deficit can be adjusted against, okay, special rates of taxation, okay, except lotteries, except winnings. My dear friends, this deficit can be adjusted against special rate. Okay, this 50,000 can be adjusted against STCG on which STT is paid, LTCG on which STT is paid, general LTCG. Whereas it cannot be adjusted against lotteries. It cannot be adjusted against lotteries. Suppose I give a circumstance where I don't have income taxable at normal rate. Normal rate income is nil. And I have winnings alone to the extent of 50,000. My total income itself is 50,000 and that is due to winnings. My dear friends, I am liable to pay 30% on 15,000. I am liable to pay 30%. I cannot adjust, which means winnings is taxable right from rupee 1. Winnings is taxable right from rupee 1. Are we clear? Are we clear? So, remember these things when we are working out a question also, when you are working out in the examination also, when tax comes, be cautious on these things. Whenever there is a winnings, okay, even in the gross total income column, it might be whatever may be the amount. It might be less than winnings amount also because of loss adjustments, etc. House property loss can be adjusted against any income. So I will even adjust it against winnings. But honestly, that is just for computation of gross total income. When we come to tax computation, the winnings is taxable in whole, in full. Is the class clear? Okay, so these are all some things, some small things which we will remember for while working out the question. As I told you, we are going random manner. We are though I have significantly separated chapter wise, but we will always work out it in random manner. Before going into, before again going into any of these things, I want you to understand what is 115 BAC. Because we are giving concession, we are not going to allow certain items, certain deductions, exemptions, we are not going to allow. Okay, so let us start in our notebook, okay, and keep it written in our notebook. Section 115 BAC. Section 115 BAC. Section 115 BAC. Okay, so we are going to talk about what is allowed, what is not allowed, and I am going to split it into 5 heads first. Okay, 2 types of chart will come. Okay, first chart is 5 heads, then we will go for clubbing, set off, and deductions. Okay, right, we will go for 5 heads now. Okay, salaries, house property, business or profession, capital gain, and other sources. Okay, and other sources. What is allowed or not allowed? When I say salaries, okay, I mean like the most important section 1013 HRA will not be allowed. Section 1013 HRA will not be allowed, my dear friends. Okay, section 10 subsection 14 children education allowance, hostel allowance will not be allowed. Children education allowance, hostel allowance will not be allowed. 10.5 LTC, that by the shortest route it is available only for 2 children, and if in the second birth it is a twins, it is allowed for 3 children. Okay, that is not allowed when you are following the 115 BAC. Okay, right. Interestingly, standard deduction is now allowed. Standard deduction is now allowed. Okay, standard deduction will be allowed, but Section 16(2), entertainment allowance. Of course, it is for government employees. 16(3), professional tax will not be allowed. Will not be allowed. Okay, section 16(3), professional tax will not be allowed. Okay, right, friends? What will be allowed? What will be allowed if I look at it? Okay, this transport allowance for physically challenged people. Okay, okay, transport allowance for physically challenged people will continue to be allowed, 3,200 irrespective of actual amount spent. 3,200 per month irrespective of actual amount spent, that will be continued to be allowed even if the assessee is following the concessional tax regime. Okay, all official allowances he can continue to claim. What do I mean by official allowance? Conveyance allowance to the extent used for official purpose, traveling allowance to the extent used for official purpose, uniform allowance to the extent used for official purpose can continue to be claimed. Is the class clear? Okay, and all terminal benefits, exemption for terminal benefits can continue to be claimed. What is exemption for terminal benefits? Gratuity, okay, commuted pension and leave encashment can continue to be claimed even if the assessee is following 115 BAC. Even if the assessee is following 115 BAC. Is the class clear? Okay. Now, if I look at house property chapter, I will, okay, only one thing, but that is the most important. That is the highly tested area. Interest on self-occupied property. Interest on self-occupied property. My dear friends, in the case of a self-occupied property, we can claim interest up to 2 lakhs if the property is, if the loan is taken for purchase or construction, 30,000 if the loan is taken for repairs or renewals. But however, it is overall restricted to two properties. I mean, it is overall restricted to 2 lakhs for both the properties where I can claim self-occupation. This cannot be claimed if you are following 115 BAC. If we are following 115 BAC, this cannot be claimed. And remember, only this cannot be claimed. Interest on let out property can continue to be claimed. Interest on let out property can continue to be claimed. Okay. Okay. Other than this, there is nothing that is there in a house property that you need to remember. But this is a repeated question area. Why it is repeated question? I'll come to that. Why it is repeatedly questioned. Okay. And then comes PGBP. You cannot claim additional depreciation. You cannot claim additional depreciation. We cannot claim contribution to external agencies for scientific research or social research or statistical research. Okay, for scientific, social, statistical research. What I cannot claim? Contribution to external agencies. I cannot claim it as a deduction. Contribution to external agencies, I cannot claim it as a deduction if I am following 115 BAC. Of course, okay. Of course, I'll write it also. I can still claim in-house research expenditure. 100% of capital expenditure will be allowed. I can still claim. Only contribution to external agencies cannot be claimed if I am following 115 BAC. Other than this, okay, there are some skill development which are not there in our syllabus, 33 AB, which are not there in our inter syllabus. Okay, some deposit based deduction, some skill development expenditures, all those things are not there. So you need not worry about those things. Remember these things, this is enough. So in our what I can claim, you should write and keep, okay, here, in-house research expenses, I can continue to claim. I can continue to claim in-house research expenditure. Okay. Interestingly, there is nothing in capital gain because capital gains are taxable at a special rate. I don't want a 115 BAC there. Okay, there is nothing in capital gain to talk about 115 BAC because of only one reason. Capital gains is always taxable at a special rate. Whether you follow the normal tax regime or the concessional tax regime, it is one and the same. It is one and the same. When I go to income from other sources, okay, please remember this minor clubbing cannot be claimed. That 1,500 rupees of minor clubbing, okay, 1032, okay, rupees 1,500 for clubbing of minor income. This cannot be considered by me. Okay, rupees 1,500 under 1032 for clubbing of minor income, I cannot claim. Otherwise, everything is claimable. Okay, now please remember, you can even claim this standard deduction for family pension. Okay, you can claim standard deduction for family pension because still last year it was not allowed. Now that 1/3 or rupees 15,000, whichever is less, can be claimed under income from other sources. Is the class clear? Okay, this is what is important to understand. Shall I go to the next table? Okay, right. Continuing with section 115 BAC. Continuing with section 115 BAC. Because I have already done this minor clubbing, I am not taking it in the clubbing chapter. We have already taken it in the IFOS chapter. Now there are two things, set off and deductions. Okay, now there are two things, okay, set off and deductions. Okay, my discussion on set off for you, asking you to remember, is something important again. I had told you, if you remember, set off of losses. House property loss can be set off against any head only to the extent of 2 lakhs. Balance has to be carried forward, but that is only under the normal tax regime, because there the loss can arise due to let out property and self-occupied property. Because I can claim interest on self-occupation there as a deduction. So the loss can arise both in let out property and self-occupation property, whereas here you cannot have loss of self-occupied, because self-occupied you are not allowing the interest. So let out. So in the set off provision, the law has said, favorably said, whole of the HP loss, obviously it is because of let out, okay, can be claimed. Whole of the house property loss can be claimed. Whole of the house property loss can be claimed. There is no restriction of 2 lakhs. In the normal tax regime, there is a restriction of 2 lakhs, balance to be carried forward. Here, there is no problem. Wholly, it can be claimed. Okay. Now, I am coming to what cannot be. That's why I said that this is the benefit that they get. This is the bigger benefit they get because they are foregoing one benefit. What cannot be claimed? Okay, brought forward HP loss due to self-occupation. Last year I was in the normal tax regime. There was a house property loss of self-occupation, which I am unable to be set off against any head. I brought it forward this year. This year I am preferring default tax regime. I cannot set off that brought forward house property loss because it cannot, it is not allowed, self-occupation. Okay, brought forward unabsorbed depreciation due to additional depreciation. Brought forward unabsorbed depreciation due to additional depreciation. If there is a brought forward unabsorbed depreciation due to additional depreciation, I cannot set it off. I cannot set it off. Similarly, brought forward unabsorbed scientific research contribution. Very rare, but still write and keep. Brought forward unabsorbed scientific research contribution. Scientific research contribution. Is it clear? Okay, right. None of the deductions. None of the deductions except, okay, 80 CCD subsection 2, employer's contribution to pension fund to the extent of 10% of salary. I am first adding it up on the top. I am first including it as a part of gross salary and then allowing it. 80 CCD subsection 2. 80 CCH subsection 2, contribution to Agniveer funds. Contribution to Agniveer funds, employer's contribution. Again, adding it on the gross salary, reducing it here. Okay, 80 JJAA. 80 JJAA, new employees. For new employees, 30% of additional wages paid will be allowed as deduction. 30% of additional wages paid will be allowed as deduction. These are allowed. Of course, ATM is not there for your syllabus, so don't worry. Is this clear? Okay, is this clear? Okay, so remember these things before going into the examination. Just browse through these tables so that we are clear. Okay, all possibilities of new tax regime being more questioned because that becomes popular, and the finance minister has already announced that there is going to be a new tax code, which means the old system might go off and only the new system will be prevailing. Okay, so this is the entire of 115 BAC. Okay, right, fine. As I said, that surcharge and all, we will keep working, or later we will take up some questions both on surcharge, and I also want to just browse through this rebate and marginal relief on rebate, general marginal relief. Even if it is not there in the revision material, later I will take up a question and revise. Am I clear to you? Okay, let's start with the residential status chapter. Residential status and scope of income chapter. Okay, should I send my dear friends? I'm looking into question number. Okay, before that, let us quickly recollect the chart of residential status for individuals. Residential status for individuals. Okay, quickly we'll recollect this particular chart. Okay, there are two conditions. Okay, basic condition and additional condition. Okay, there are two conditions, basic condition and additional condition. Each condition has two sub-aspects. The basic condition also has two sub-aspects, 182 days or more during relevant previous year. during relevant previous year, which is 23-24 for all of us. 182 days, if a person is here, he becomes my man, he becomes a resident. He becomes a resident. The second basic condition is 60 days in relevant previous year plus 365 days or more in 4 years preceding relevant previous year. 365 days or more in the 4 years preceding the relevant previous year, and any one condition you satisfy, you become a resident. Any one condition you satisfy, you become a resident. Then comes a small aspect of understanding. This is not applicable for the following category of assessee. Okay, Indian citizen leaving for employment. Indian citizen leaving for employment. For them, second basic condition need not be tested, only the first condition. Member of ship crew. Okay, member of ship crew and Indian citizen or person of Indian origin visiting India. For all these three types of people, the second basic condition is not applicable. Only the first basic condition is applicable. The second basic condition is not applicable. Only the first basic condition I need to test it. When I am saying this, I also recollect something. Okay, a member of a ship crew, when he is considered outside India, the day he enters the ship, he has gone out of India. The ship might be in India, but the day he has entered the ship, he has gone outside India. Okay, so the law says exclude date of signing in to the date of signing out. The law says in our ship, a member of a ship crew cases, if it is a foreign bound ship, if it is Indian bound ship, nothing. If the destination of the ship is outside India, if it is a foreign bound ship, a person, a crew member, what I will exclude is date of signing in to date of signing out. He is considered to be outside India. The other dates only I will check. So that is for a member of a ship crew. So there are two basic conditions. The second basic condition is not applicable for certain category of assessees. Then comes the additional conditions. There are two additional conditions. There are two, okay, at least, that is minimum, in 2 out of past 10 years, he should be a resident, which means he should have satisfied one of the basic conditions. Any one satisfying the basic condition will be a resident. At least 2 out of the past 10 years, he should be a resident. Okay, okay. In past 7 years, he should be in India for 730 days or more. Okay, this is plus condition, which means both has to be satisfied. This is a plus condition, which means both has to be satisfied. And the law says if an individual satisfies any one of the basic condition, satisfies both the additional condition, ROR, satisfies one basic condition, does not satisfy any one or both the additional condition, RNOR, does not satisfy the basic condition itself, NR. Does not satisfy the basic condition itself, NR. Then came the two special provisions. Before going to that special provision, let us quickly understand this income part of it. Okay. Now I am going for scope of total income. For a ROR, global income is taxable. global income is taxable. Wherever he earns, however he earns, it becomes taxable. Wherever he earns, however he earns, it becomes taxable. For a RNOR, for a resident but not ordinary resident, okay, received in India, okay, accrued in India, okay, business or profession outside India but managed, okay, set up from in India are taxable. For a RNOR, what is taxable? Receipt test, accrual test, and business or profession outside India but managed from India is taxable. So what is not taxable or what cannot be taxable for a RNOR is, okay, accrued and received outside India is not taxable. Accrued and received outside India is not taxable. For a non-resident, okay, received in India and accrued in India will only be taxable. Will only be taxable. Okay, so what is not taxable for a non-resident? Business or profession outside India, wherever you manage, and accrued and received outside India, both are not taxable. Both are not taxable. Okay, am I clear to you? Am I clear to you? Okay, so in no cases inward remittances are taxable. If the law used the word past year's profits brought into India, never give any, even the word untaxed might appear, it is not taxable. Only current year income is taxable and inward remittances are not taxable. Okay, okay. Now comes this condition of, okay, deemed resident, okay, and the taxation of deemed resident. Okay, who is a deemed resident? Indian income exceeds 15 lakhs. Indian income exceeds 15 lakhs. What is Indian income? Received, accrued, and business or profession managed from India. These are known as Indian income. If this income exceeds 15 lakhs, okay, not a resident anywhere else, he is an Indian citizen. He is an Indian citizen. He is not a resident in anywhere else and his Indian income has exceeded 15 lakhs. In this case, he will be considered as deemed resident. In this case, he will be treated as a deemed resident. Is the class clear? Is the class clear? Now going back a bit. Okay, now going back a bit. Going back a bit, we all know that we wrote it here about not applicable for Indian citizens or persons of Indian origin. Here, I want to make a small change, okay, right? Here, the law says for Indian citizen or person of Indian origin, okay, if their Indian income, which we now know what it is, exceeds 15 lakhs, if their Indian income exceeds 15 lakhs, The second basic condition will be 120 plus 365 and not 60 plus 365. The second basic condition will be 120 plus 365, not 60 plus 365. Keeping all these things in mind, let me answer some of the residential status and scope of total income question. I am not ruling out from the examination these questions. These questions can definitely come. Okay, I am looking into question number 1. In page number 4 of our revision material. In page number 4 of our revision material. Mr. Rupankar Roy, an Indian citizen, left India for employment purposes, okay, on 1st October. He came back on 30th March for visit and returned back to USA after staying for 20 days. During the previous year, he earned salary in USA, interest received in India from fixed deposit. Determine that residential status and tax incidence. Period of stay in India during the financial year 23-24. April to September plus 2 days of March, that is 30 and 31. Okay, so April, May, June, July, August, September, October 1 day is there. Yeah, plus 1. Okay, October also plus 1 plus March 2 days. 186 days. 180 days, 6 days. Okay, he satisfies the first basic condition. Hence, he is a resident and ordinary resident because this is the first time he has gone out. This is the first time he has gone out. Am I clear? Am I clear? Majority of the questions, almost 75-80% of the questions are new questions with that those which we have not worked out in our classroom. That's what I have picked. And I have picked questions from MTPs, RTPs, recent MTPs, RTPs, so that it is closer to the examination or closer to the aspects. Okay. Because our friend Vengulan was asking me whether I'll work out same question or new question. If it is same question, I'll have better jobs to do. That's what he said. Okay. Joshi discloses his income during the financial year. Interest on German development bonds, 1/6 received in India. Income from house property in India, received in Australia. Income from agriculture in America, received in India. Income from business in Canada, controlled from India. Income from business in Singapore, controlled from outside India. Calculate his income if he is a. So quick question on these things. Interest income from German development bonds, 1/6 received in India. So for ROR, fully taxable, wherever he earns, okay, income from house property. I need not read anything more. Okay. Okay. Target today, residential status, salaries, house property. Target tomorrow, PGBP, capital gains, uh, IFOS set-offs. Okay. And then 1.5 full days of assessment of individuals. Some 12 questions we are going to work from random basis. And then for the remaining TDS, the advanced tax, and that's the plan of action. Raja. Yeah, for on this, let me clarify to you for the whole class as such. There is a difference between rent and income. Rent means we have to provide. Income means they have computed. The word income means after providing all deductions. For example, income from profit and gains. You need not provide depreciation or anything. They have. They have given the gross amount. In the future classes also, in the examination question also, if they use the word income, that means they have computed. They have computed all the deductions. Okay. If they use the word rent or gross income, then only the question of deduction takes place. Question number 3. Mrs. Ria, aged 62 years, was born and brought up in New Delhi. She got married in Russia and settled there. Since her marriage, she visits India for 60 days each year. The following are the breakup of their income. pension from Russian government, LTCG on sale of land at New Delhi, short-term capital gain on sale of shares of India listed company in respect of which STT was paid both at the time of acquisition and at the time of sale, premium paid for self to Russian Life Insurance Corporation, rent received equivalent to annual value in respect of house property in Delhi. Okay, so here it is rent received. Here we have to provide the standard deduction. You are required to ascertain the residential status and compute the total income under default tax regime. Compute the tax as well. Read through the question. She visits India for 60 days each year on her summer break. Okay. Shall I, friends? Okay. Roman 1, salaries. Okay. Please, in examination, make it apparently clear. Write what is obvious. Please tell the examiner that you know the provision. Okay. Not taxable in India as it is earned outside India. House property, rent received 90,000. Okay, standard deduction under section 24A, 30% of rent. This can be claimed irrespective of the regime, do not worry. There's no business or profession. May I? May I? Okay, friends. Income taxable at normal rate is only 63,000 rupees. Is only 63,000 rupees. Deficit, that is difference between basic exemption limit, which is 3 lakhs, because assessee is under default tax regime, and income taxable at normal rate is 3 lakhs minus 63,000, 2,37,000. This can be adjusted against STCG on which STT is paid to the extent of rupees 60,000, and the balance towards LTCG under 112, and the balance against LTCG under 112. So taxable LTCG will be, okay, friends, 3 lakhs, okay, minus 237 minus 60,000, 1,23,000. The tax will be at 20%. The tax will be at 20%. The tax will be at 20%, but I have an advantage, less rebate under section 87A. In case of new tax regime, if the total income does not exceed 7 lakhs, rebate can be claimed. Rebate will be actual tax or rupees 25,000, whichever is less. Pakka clear? Maharaj, tell me. I agree with you that you feel that if I had taxed it at 15%, no, always reverse order. Okay, this is a revenue seeking law. If at all there is 112A, first 112A, then 111A, then 112. I understand you will become a great chartered accountant in the future. Okay, but that is not possible here. Okay. Question number 4. Similar question. Mr. Akash, a Indian citizen, worked in New Delhi. He got a job offer on 1/6/22, left India for the first time and joined that company. During this year, he was in India between 22/5 and 22/9. He received the following income. Salary from ABC Incorporation, California received, computed. Dividend from Indian company. Agricultural income outside India received outside India. Rent received. So here the word used is rent. Okay. Profit from a profession outside India but managed from India. Determine the RS of Akash and compute his total income. in the financial year 22, 23, 24, 25th May to 22nd September. Okay, in May, 7 days. 25, 26, 27, 28, 29, 30, 31. May, 7 days. June, July, August, and September. Okay, 121 days. 121 days. Okay. (121 days). He is an Indian citizen visiting India. Okay. Now I will do the income and then come to the residential status. I will do the income and then, because this exception clause of 120 days might be applicable if his Indian income is going to exceed 15 lakhs. So I am going to compute the income. Salary will not come. Okay. His Indian income has not exceeded rupees 15 lakhs. Hence, the second basic condition is not applicable. He is a non-resident. Okay, since he is a non-resident, business outside India but managed from India is also not taxable. Therefore, his total income, Indian income, will be 14,85,000 minus 6 lakhs. Check it out. If you don't understand, ask me. Okay. If he is a R and OR, this would have been taxable. If he is a, but since he became a non-resident, this part of the income will not become taxable because it is income earned outside India, managed from India, not taxable for NR. So his Indian taxable income will be the house property income and the dividend. Hmm? Mrs. Sia D'Souza is an American, got married to Mr. Kabir of India in New York on 14th of Feb 23 and came to India on 18th of March 23, left on 16th August 23, returned back on 28th, 23rd March 23, 24. On 1/4/23, she had purchased an apartment in Mumbai, which was let out to Mr. Samir on a rent of 26,000 from 1st of June. She had taken a loan from the Indian bank for purchase of this apartment, for which the bank charged 2,05,000. While in India during the year, she had received a gold chain from her in-laws worth 1,50,000 and 1,65,000 from her close friends of her husband. From the information, you are required to determine the residential status, compute the total income chargeable to tax, and assuming she has shifted out of the default tax regime under 115 BAC. Read through. Period of stay in India for the financial year 23-24. Okay. She left for Australia. She returned to India on 23/3. Okay, sorry. For the first time, she came into India on 18/3/23 and she left. So 1st April to 16th August plus 23rd March to 31st March. Is that right? Is that right? Okay. So April, May, June, July, or August 16 plus, okay, 23, 24, 25, 26, 27, 28, 29, 30, 31. 9 days. 9 days in March. 147 days. And this is the first time she has come into India. She does not satisfy the first basic condition. She does not satisfy any of the basic condition. house property.
Sir, one doubt, sir.
Go ahead.
Sir, how is it from 1st April, sir? Isn't it from 16th August?
She got married came to India on 4th. Oh, she got married on that day. Came to India in the financial year 22-23 itself. She came to India on 18th March 23, financial year 22-23, but we are only worried about financial year 23-24. And after coming, she left for Australia on 16th August. So, from March 18th to August 16th, she is in India. But our financial year starts from 1st of April. That's why I have taken from 1st of April.
Okay, sir. Thank you.
Into 10 months. Contiguous, nothing. Shall we? Shall we? Okay. I'm doing so many questions because it has a lot of other chapter questions also, like gift, like house property. So we are able to cover. Geeta, a citizen of India, got married to Peter and left India on 20th August. She did not visit India after that. She has derived the following income. Income from sale of centrifuged latex processed rubber. Okay, friends. Tea and coffee, 60-40. 60% is agricultural income, 40% is business income. Rubber, 65-35. Saplings, not at all, 100% agricultural income. Once more, tea and coffee, 60-40. Okay, no, we'll write it. When we do the solution, we'll write it. 60-40, tea and coffee. Rubber, 65-35. And saplings. But in coffee, there is a category called grounded and roasted. That is 60-40. Raw coffee, okay, which is not grounded and roasted, 75-25. So here, let's make a marking, 65-35. Okay, income from sale of coffee, grown, cured, roasted and grounded in Colombo, 100% business income. Because only Indian agricultural income you will classify. Only Indian agricultural income you will classify. Agriculture income from outside India, fully taxable. Tea, 60-40. Saplings, okay, nothing is taxable, 100% agriculture income. You are required to determine the residential status and compute the business and agricultural income of Geeta. Remember, satisfies the second basic condition as she is not leaving for employment. She is not leaving. She got married and leaving. That's what the question says. Got married to a person in Australia, so she left India. Okay, she is not leaving for employment purposes. So that 60 plus 365, she has satisfied. And she satisfied all the additional condition also. Okay. Income from rubber, 65% share. Okay, I'll have it as particulars, agri income and business income. Okay, 65% is agri and 35% is business income. So out of 1,50,000, In exam, you will not write remember. Here, examiner will say, why should I remember? Is it clear? Is it clear? Okay, okay. Though the question has not asked for, I'm going to do the taxation because it's an opportunity to recollect the agricultural tax. In the case of an individual where he has both agricultural and non-agricultural income, there are 4 steps of computation. There are 4 steps of tax computation. Step 1, by including the agricultural income, I will compute tax. Okay, I will compute the total income by including agriculture income. Step 2, tax on step 1. Step 3, basic exemption limit plus agricultural income. Step 4, tax on step 3, net tax, and then only we will add special rates, etc. All these things. In this case, I am going to work out that and see, because an opportunity to recollect. And I'm going to work out under default tax regime. Step 1, total income by including agricultural income. Step 2, tax on step 1. Friends, 5,50,000 into 30% plus 1,50,000 up to 15 lakhs, 1,50,000 under default tax regime. Okay. Okay, just to recollect, first 3 lakhs nil, next 3 lakhs 5%, 15,000, next 3 lakh 10%, okay, next 3 lakh 45,000 plus 1,17,500 into 20%. Once more repeating, 1,317,500 is the income. First 3 lakhs nil, up to 6 lakhs 15,000, up to 9 lakhs 15 plus 30, 45,000. Up to 12 lakhs, another 45,000. And the balance 117,500 into 20%. Clear? Clear? Okay. Interesting question. We learned something, and also we learned the agriculture income taxation as a value addition. Shall I? Okay. Let's take a small break and come back for salaries. Very small break. Not a breakfast break. With a small note of apology, I start my salaries. Because in salaries RFA, I just taught you the new system without teaching you the old system. But when I looked into the judicial update only, that was well before I learned that, up to 31st August, the old system, and from 1st September, the new system. I'm not sure whether they will question, but we should remember this. Okay. For your year alone, the year before had only one thing. This year had only one thing, the new. But for you people alone, okay, your extra memory power is required. Okay. I'm just going to talk about perquisite value of RFA. This is our material, judicial update, where you can see they would have written it as okay, with effect from 1st September. So first 5 months, April, May, June, July, August, there is a methodology. And after that, there is a methodology. Okay. Okay, actually particulars of the population. Okay. Up to 10 lakhs. It was previously 7.5% of salary. Now, up to 15 lakhs, it is 5% of salary. Okay. More than 10 lakhs, but less than 25 lakhs. 10% of salary. Now it is more than 15 lakhs but less than 40 lakhs, 7.5% of salary. More than 25 lakhs, it was 15% of salary. More than 40 lakhs, it is 10% of salary. All other government employees same, furnishing same, hotel same, all other things are same. Only this table, please take it down. I'll work out and show you. Suppose 12 months they gave you. First 5 months salary, next 7 months salary. Both should be done in the working note. Suppose if they give you, they have not, because even in the November exam, September examination, they did not go into it. Okay, obviously a old provision need not be questioned, but we should always be prepared. In one of the question, I'll work out and show you. And we all know salary is equal to basic pay plus DA forming part, yeah, plus all monetary receipts plus all other allowances to the extent I'll try to find out. A quick brush through of salaries. HRA exemption, we all know. Actual HRA received, rent paid minus 10% of salary, 50 or 40% of salary. 50 is metros, 40 otherwise, cannot be claimed under new tax regime. CEA 100 per month per child for maximum of 2 children. Hostel allowance 300 per month per child for maximum of 2 children. Both cannot be claimed under new tax regime. That the 115 BAC regime. And then if I go forward, all official allowance, uniform, conveyance and traveling expenses, to the extent that they are officially spent, is exempt. Transport allowance is fully taxable. However, for an employee who is physically challenged, we will provide a exemption of 3,200 irrespective of actual amount spent per month. And that can be claimed under 115 BAC also. Okay, all other allowances are fully taxable. And then when I go into perquisite, I have to remember the medical perquisite part of it. There are some exemptions like government hospital, hospital owned by the employer, specified diseases, and treatment outside India along with one attendant. Okay, these are going to be exempt. Otherwise, we know the taxability of various things. Interest will be straightforward, SBI rate will be given. Okay, transfer of asset. The depreciation rates are 50% for electronic equipments, including computers, 20% for motor car, both these things in diminishing balance method, and 10% for all other assets in straight line method. Okay, motor car, depending upon the ownership, we need to remember 1,800 and 2,400, which will be either a perquisite taxable or perquisite allowed as deduction. Actual expenses minus, depending upon who the owner is. Okay, and the terminal benefits, those are taxable. Standard deduction is 50,000 rupees, even 115 BAC you can claim. Entertainment allowance, first I will tax it. Later, I will provide it as a deduction up to rupees 5,000 per annum, provided he is a government employee. Otherwise, this is not provided. And professional tax, there are two ways. Professional tax deducted from employee, allow it as deduction. Professional tax of employee paid by employer. First include it in the gross salary, then allow it as a deduction under 16(3). Why I am saying is, if it is new tax regime, only I will include. I will not give it as a deduction. So this is the way. Two things that takes our attention is provident fund contribution. Employer's contribution only up to 12% is allowed. More than that, it becomes taxable. Employee's contribution is always included in salary. We need not worry. But when we are working out deductions under 80C, we should take employees, whatever contribution employee has made, provided he is following the old tax regime. Pension. Employer's contribution, first add it in the gross salary, then provide 80CCD subsection 2 to the extent of 10%. That is available also for the new tax regime that can be claimed, because it's just the addition and deletion. Provident fund and pension are two. There is only a small difference. Provident fund, in excess of 10% only, I am taxing. Pension also in excess of 10% only, I am taxing. But the methodology is, suppose 15% is contributed, I add 15%, reduce 10%. Net effect is, it's like also provident fund. In excess of 10%, I am going to tax. Okay, but the manner of computation differs. The manner of computation differs. Am I clear to you? Okay, let's start doing some questions of salaries. Mr. R. Singh, the employee of BPL India Limited, furnished under noted particulars of his income for the previous year. Compute his income from salary for the year. Basic pay, DA, medical allowance, fully taxable. Please remember, even in some questions, they will say this is used fully for medical treatment. No, it is fully taxable. He and his employer contributes 14% of salary to RPF. Interest credited to the fund at 11%. Interest is up to 9.5% allowed. His personal electricity bills amounted to 20,000, out of which he paid only 5,000, balance paid by employer. He is provided with a small car with a driver for both official and personal uses, expenses met by employer. Life insurance premium, professional tax was paid by employer. Okay, professional tax was paid by employer, 2,400. Let's start doing it. Suppose you are doing any working note, okay, in the examination, leave 3/4 of the page for computation of salary, followed by that do the working note. Even though you will start with the working note should follow the main answer. Working note should follow the main answer, except one working note which forms part in PGBP depreciation. Working note is forming part of the answer. So first you can work out depreciation followed by computation of income. But if you are, for example, in this question, if there is an HRA and you are working out a HRA exemption working note, please do it as a separate working note. After, it should follow the main answer. Okay, we should not allow the examiner to search for our answer. It should be apparently clear. Am I? Excess contribution by employer to RPF. Okay, 7,20,000 plus 2,40,000 into 2%. That's deduction, nana. Paid by employer. Sorry. Sorry, I stand correct.
Sir, why are we assuming it as old tax regime, sir?
No. It's, you can assume it as new tax regime. I don't have a problem. In which case, you will not allow the deduction.
Okay, sir.
Which one? If it is a medical insurance policy, group insurance policy, it is exempt. Personal accident policy, it is exempt. This is a life insurance policy, always taxable. No, if they insure medical insurance policy, exempt. Medical insurance policy is exempt because it is either group insurance or personal accident policy. Both are not taxable. Shall I? Anybody still doing? Yeah.
Sir, if in question is not given which region to use, we should compute both the.
No, sir. No, friend. You can assume it. You can assume it.
So anyone is.
Yeah, anyone is. Mr. X is working with ABC Limited since last 30 years and 9 months. Mrs. X, her salary structure was basic pay DA. On 15/12, she died. Discuss the treatment. Mrs. X retired on 10/12. Gratuity 4 lakh received by her husband on 18/12. Case 2. Husband of Mrs. X received gratuity on 18/12. Falling due to the death of Mrs. X. Mrs. X is covered under Payment of Gratuity Act. My dear friends, a situation where employee post-retirement is eligible for gratuity. Employee post-retirement is eligible for gratuity. Dies, because of which, that is after retirement only, employee dies, because of which legal heir are receiving it. Taxable. Taxable. This is a case of taxability. Husband of Mrs. X received due to the death of Mrs. X. That is, even before it became due, or the due is because she died. Not taxable. Remember, legal heir receiving the gratuity of the deceased employee. Deceased employee is due to receive gratuity, but before receiving dies. Provisions of salary chapter will apply. Due to death only, legal heir is receiving. Otherwise, she would have still continued in employment, not tax. Are you understanding the difference? Okay. Oh, no, sorry. The question has not asked for taxable gratuity. Sahil, a resident individual. Sorry.
You can save your time more precious than money.
Sahil, a resident individual, is an assistant manager. He gets a salary of 55,000 during the previous year, received the following: DA 10% forms part, bonus, fixed medical allowance 50,000 for meeting the medical expenditure. He was reimbursed medical bills of his mother dependent on him amounting to rupees 6,500. Sahil was provided with a laptop both for official personal purposes. Laptop was acquired for 35,000, not a perquisite. Usage of laptop or desktop computers, not a perquisite. Domestic servant, which was reimbursed by the employer, perquisite. Fox Limited allotted 700 equity shares at a rate of 170 when the fair market value is 280. The FMV was computed in accordance with the method. Professional tax, out of which 1,400 was paid by the employer. Compute income under the head salaries if he is paying tax under default tax regime, that is 115 BAC. Okay, actually together we should work. You should not even see the uh, working. You should work and then see. Done? Anybody still doing? Anta, completed? Hope you are not doing it in calculator but in notebook. Sailesh is a marketing manager. Salary, basic salary, DA, health insurance scheme of approved by IRDA, 20,000 health insurance scheme. Okay, not a perquisite. Unless they say it is not a personal accident, it is a normal medical policy only for this individual, which is received 10,000 as gift on the occasion of wedding anniversary, taxable. Smile Limited allotted 800 equity shares, provided with furniture during September 2019. The furniture is used for its residential purpose. The actual cost. On 31st March, the company offered the furniture to him at free of cost. No amount was recovered. So there are two perquisites in this: usage for the full year of 23-24, at the end of 24, transfer. And it is furniture 10% straight line method. Okay, received 10,000 towards entertainment allowance. Housing loan at 4.5% was provided by the company. Amount outstanding as on 1/4/23, 50,000 is paid every quarter towards principal. The lending rate of SBI is 8%. Facility of laptop costing 50,000, which is not a perquisite. Okay. I'm again going to do salaries in this combination of assessment of individual. Okay. And sorry, Bala, to disappoint you. I wrongly said salaries. Let's keep up the house property before the breakfast. Okay. Don't ask me now. You said after salaries, breakfast. No, you're not supposed to eat. Huh? Oh, okay. ಅದು ಮಾತ್ರ ಮಾಡ್ತಿರೋ. Okay, again, the same rule. You please do it and then check. 20, 21, 22, 23. 4 years completed. 4 years completed.
Sir, is it not important to include the alternative school of thought for gifts,
Yeah,
sir?
yeah, I'll write that. I'll write that. I'll definitely write. Actually, 15 lakhs into 3.5% into first quarter of 3 by 12. 14 lakh 50,000 into 3.5% into 3 by 12, because every quarter they are repaying 50,000.
Sir, if nothing is mentioned about DA, should we consider it as forming part, sir?
Yes, but in this question, there is no requirement of there is no HRA, RFA, or any of this PF, etc. That's why they have left it blank. We can always say that it is forming part if nothing is mentioned.
Okay, sir.
Starting from June,
Yeah,
then June 2023 first quarter.
April, May, June. June 30th, that's what we have taken it.
So the facility of laptop means transfer or something.
No, facility only. Only per usage. May I? Okay. Do you understand this? Okay. Yeah. We'll again do. Don't worry. I am going into house property now. I'm going into house property now. I'm going into house property now. Okay. We all know it is classified into self-occupied and let out. Okay. NAV of a self-occupied property is nil, and you can claim interest as a deduction up to 2 lakhs if you are following the old regime. Otherwise, you cannot. This will only result in a loss of 2 lakhs. This is for 2 properties you can claim. Okay. However, this interest of 2 lakhs will become 30,000 if it is for repairs or renewal. If it is for repairs or renewal of a property, it will not be 2 lakhs, 30,000 only, and this is the aspect of it. Okay. Other than that, in the self-occupied property, don't even think of anything else. Don't even do this municipal value, etc. and all. Okay, direct working. Now coming to our let out property computation, there are these following factors: municipal value, fair rental value, standard rent, net actual rent, nothing but actual rent minus unrealized rent. Actual rent minus unrealized rent. I will determine whichever is higher. I will determine whichever is lower. I will determine whichever is higher. This answer is known as expected rental value. This answer is known as expected rental value. Okay. ERV is the answer minus vacancy allowance. Suppose if the property is vacant for 1 or 2 months, rent into number of months of vacancy will lead me to gross annual value. Okay, less municipal taxes paid. When I say paid, there are following conditions. It should be paid by the owner. Municipal taxes paid by the tenant will not be allowed as deduction. It should be paid by the owner, and it should be paid in the financial year 23-24. Okay, there is nothing called before due date of filing and all. It should be before 31st March 24, in which case I will allow it as a deduction and I will get net annual value. Okay, section 24 allows the following deduction. Section 24 allows standard deduction 30% of NAV. Okay, and interest on borrowed capital. Okay, whatever may be the amount, okay, and then I will add 70% of unrealized rent recovered. The only word I should look for is it is allowed earlier. Even if it is silent, you add. If they have specifically said it is not allowed earlier, don't add. And 70% of arrears. Arrears means in the increase in rent with a retrospective effect where it has been disputed. Now it is in the favor of owner. Both these things are taxable in the year of receipt only. And even if the property is not there with you, this is taxable. you will get income from house property, income or loss from house property. Okay. This housing loan has two aspects, interest and principal. Okay, interest and principal. Principal is allowed under 80C. The principal portion will be allowed under 80C, whatever, okay. And the interest will be allowed under 24B. In some cases, in 80EE also, in addition to 2 lakhs, you can claim some 50,000 rupees, 1,50,000 rupees, provided the conditions of stamp value not exceeding 45 lakhs and all these, the house should be the first house and it should be self-occupied. Having said this, he should not be under old system. He should not be under new system. If it is new system, 80E is not allowed and 24B is also not allowed. Am I clear to you? One small thing I want you to, small nuance which we have to understand is, these two should be from a recognized financial institution. To claim 80C or to claim 80EE, it should be from a recognized financial institution, whereas this can be from anyone. Even if I have got from my friend a loan for constructing my house property and I have paid him interest, that can be claimed. That can be claimed. But the principal I am repaying cannot be claimed under 80C. Or the excess I repaid cannot be claimed under 80EE. This small nuance, please understand, that is 24B can be from anyone, whereas 80C or 80EE only the, okay, recognize the financial institution. If it is paid, it will be allowed. Okay, okay. Apart from this, for your general understanding, I am telling you all these things. Suppose if a house property is let out for part of the year and self-occupied for the other part of the year, I will deem it to be let out for whole of the year. That is, this MV, FRV, SR and all I will take for full year. Only the actual rent will be for actual let out period. This one thing, please remember. 2, it can be a small MCQ also. House property which is held as stock in trade. For 2 years, the NAV will be nil. After that, either you should have actually let it out or I will consider it as deemed to be let out. Deemed to be let out. Okay, right? In the house property chapter, okay, one question from material you should definitely recollect or you should definitely work out is, Ganesh owns 3 houses. Okay, there is one question from our material where Ganesh owns 3 houses. All the 3 are self-occupied. We would have worked out 3 options. House 1 and house 2 self-occupied. House 3 deemed to be let out. Various options. If you work out that question, you will get enormous clarity about computation of house property. Okay, one question from material surely work. I'm not reworking it in the classroom, but definitely you should try it out. Okay, that particular question. Otherwise, let us go into the chapter and crack it. Question, tell me. Question number 1. Mrinal Thakur owns 2 houses. The particulars are municipal value, FRV, SR, AR. Fire insurance not allowed. Interest on loan taken for construction. Interest on loan taken for repairs. Second house is a compute income if he has not opted for option under section 115 BAC 6. What does this mean? That means he is in the new system. If he is opting for 115 BAC subsection 6, that means he is opting out of the new system and going for old tax regime. If he has not opted, which means he is under new, this entire thing you can forget it off. Because under new, self-occupation nil, but no deduction of interest. No deduction of interest. Is the class understanding? Okay. Eight lakhs, 18 lakhs, 18 lakhs, 18, 15, 15, 15, 12, 15 lakhs. Mr. Ajnabi has a house property in Cochin. The house property has a 2 equal dimension residential unit. Unit 1 self-occupied unit throughout the year, and unit 2 is let out for 9 months, and for remaining 3 months self-occupied. Compute his taxable income from the following detail. Assume that he has opted for old region. MV, FRV, SR, MT, 60% only is paid by the assessee. Interest on loan, expenditure on repairs. Okay, it will be divided on the basis of area. Okay. Okay. Municipal value will be 1 lakh. FRV will be 80,000. SR will be 1,50,000. Actual rent for 9 months. Actual rent for 9 months. Okay, 10,000 per month. Gross annual, actually, gross annual value, because no vacancy, I am directly doing. Okay. 1 lakh 80, 1 lakh. That with 150, 1 lakh. That with 90, so 1 lakh only stands. Less MT paid by owner will be 1 lakh into 10% into 60%. 40% is paid by the tenant. Is it clear? Raja, can I, Raja? Mr. Kamal, a RNOR in India during the assessment year owns two houses, one in Dubai and other in Mumbai. For a ROR, global income is taxable. Wherever he is, okay, it is taxable. Even the property in Dubai is taxable, and the mode of computation is as if the property is in India. Okay, municipal taxes, that country's fair rental, everything I'll get. Please remember, in probably it might be in final, but in some question they'll say, in that country, municipal taxes are not allowed as deduction. Don't even worry about that line. The law says as if the property is located in India. Whatever we allow here, we should reduce it. The house in Dubai is let out there as a rent of Dubai dirhams 20,000, which is 22 rupees. The entire rent is received in India. He paid property tax and sewage tax. The house in Mumbai is self-occupied. He had taken a loan of 10 lakhs for construction of the house on 1st June 2020. The construction was completed on 31st March, May 22. The entire loan is outstanding. Property tax paid in respect of second house for the financial year. Compute the income. Friends, what is pre-construction period interest? Period preceding the year in which construction of property is completed. It is not the date. It is the year. I have completed on 31st May 22. I have completed on 31st May 22. So I should leave 22-23 up to 21-22. So 2021 some 10 months, 21-22 whole year. This is pre-construction period. That interest will be allowed in 5 equal installments. So in a year, assessee can claim that year's interest plus 1/5 of PCP interest. However, in the case of self-occupation, together it cannot exceed 2 lakhs. Okay, let's do separately for Dubai, separately for Chennai property. The word empty means house tax, water tax, sewage tax, whatever is paid is empty. Profits and gains of business or profession. Okay, what needs to be remembered, what needs to be understood as the first aspect. Okay, okay. Section 28 is nothing but basis of charge. That is the income provision. In that, you need to remember compensation is an income. Any compensation received other than for assets. Assets means it will adjust in the cost of the asset. Otherwise, compensation is an income. Okay. Government grant for non-depreciable asset, that is land and general or income. Okay, subsidy received for depreciable asset adjusted with the cost of the asset. Otherwise, it will be treated as income. Otherwise, it will be treated as income. And remember, partners' remuneration and interest will be taxable as income under this head for the partner. So when you are working out individuals, whatever is the remuneration and interest that is allowed in the hands of the firm, that is allowed in the hands of the firm. Suppose 15% is paid. Only 12% would have been allowed. That 12% will be taxable as income in the hands of the partner, individual, under the head PGBP. Under the head PGBP. Remuneration, okay, will be treated as income. In remuneration will be treated as income. Business perquisites. Suppose a doctor is given a car. A agent is given gold coin. Okay, any type of business perquisite will be treated as business income. Will be treated as business income. Okay, any type of business perquisite will be treated as business income. Remember this. Okay, all these things are okay, apparently will be given. Sometimes in the P&L account on the credit side, look for these words: warehousing charges. That means they are coming under 35 AD. That business has to be separately worked out. That business has to be separately worked out. Warehousing charges, hotel, okay, rent received by a hotel, okay, or this apart from godowns, hotels, okay, housing projects, all these things, if they give, they are coming for 35 AD. Okay, if in P&L account any income of 35 AD specified business is provided, then the same should be computed separately. Don't club it and compute it. Don't club it and compute it. Why I am saying this? Because loss of specified business cannot be set off against any other income. It can be only set off against the income from specified business. So this part alone, apparently it will be there for you on the credit side. Okay, warehousing charges, etc. will be there, which you can definitely understand. Am I clear to you? Okay, these will be treated as income. Let us not worry about 30, 31 expenses in relation to building, plant and machinery, all allowed. When I go to 32, depreciation, normal and additional, only if old tax regime is followed. Okay, normal and additional. Okay, remember to provide only half of the depreciation if asset is put to use for less than 180 days. Both be it normal or additional, remember to provide only half of the depreciation if asset is put to use for less than 180 days. In case of additional depreciation, balance half can be claimed in the next year. Balance can be claimed in the next year. Am I clear to you? Balance 50%. Okay. If they are following the old tax regime only, this year I am only claiming 10%, or last year I claimed only 10% because it was put to use for less than 180 days. This year, while computing the depreciation, I will remember to claim another 10%, which I have not claimed in the last year. Okay. Proportionate depreciation, where, okay, this is very simple. Amalgamation, demerger and conversion. Compute full depreciation and distribute based on effective usage period. That is each asset, each how much they are using. Am I clear to you? In 32, you have to remember only this much. Only this much. Okay. Additional depreciation is only for new asset. Okay. If there is a second-hand asset, don't provide additional depreciation. Only normal depreciation will be provided if it is a second-hand asset. So additional depreciation will be provided only for new asset. And that too for manufacturing entity. The benefit that I get is even computers, vehicles which are used in the manufacturing process, you can claim additional depreciation. Okay. 35 talks about in-house research expenses that are approved except cost of land can be claimed. In-house research expenses except cost of land can be claimed. Contribution to external agency can be claimed only if assessee is in old tax regime. Contribution to external agency. Am I clear to you? Okay. 35 AD, specified business. All capital expenses can be accumulated and claimed except cost of land, financial instruments and goodwill. All capital expenditure can be accumulated and claimed. But if there is a loss, as I told you, I have to treat it separately. I cannot do the set off. 35D, preliminary expenses. 35DD, amalgamation, demerger expenses. 35DDA, VRS compensation. 36. Okay. Capital expenditure on family planning incurred by an Indian company. In all these cases will be allowed in 5 equal installments. In all these cases, my dear friends, if they have given the total amount, disallow the total amount and allow only 1/5 or disallow 4/5. Okay, in all these cases. Okay, in all these cases, it will be allowed in 5 equal installments. Now, when I am speaking about 36, okay, leave the normal that insurance is allowed, bad debts is allowed, STT and CTT is allowed. But some employees' welfare schemes are there. Okay, contribution to RPF, fully allowed. Contribution to superannuation fund. Contribution to superannuation fund, fully allowed. Contribution to pension scheme, okay, 10% of salary. Contribution to a pension scheme, I should all be careful that I should allow only 10% of salary. Contribution to gratuity fund, remember 8.33% of salary is only allowed. 8.33% of salary is only allowed. Okay. Any other welfare fund is fully allowed. Okay. Employees welfare scheme alone in section 36 you should remember. Otherwise, bad debts is allowed, interest on loans are allowed, all these things are allowed. But this is something which we have a restriction in 2 cases. Okay. 37 speaks about general deductions. It should not be capital. It should not be personal. It should be incurred during the previous year, incurred for the purpose of business or profession. But to be precise, the law says what is not allowed. Okay, donation, including donation to political party, advertisement in the publication of political party, advertisement in the publications of political, that will be treated as donation. You can claim 80 GGC provided you are in the old regime, but generally it will directly not be allowed as deduction. CSR expenditure will not be allowed as deduction. CSR expenditure will not be allowed as deduction. Penalties will not be allowed as deduction. A penalty means violation of law. Interest is allowed, but penalty is violation of law, which will not be allowed as deduction. Whatever be the nature of penalty, it will not be any violation of law. Expenditure incurred for violating law definitely cannot be claimed as deduction. So penalties are not allowed as deduction. Okay, right? Any perquisite which is not allowed by law. A doctor should not be given some free samples. A doctor should not be provided some tips for prescribing their medicines. These are not allowed. Again, it's like a penalty. It's like a penalty. Okay, so please remember these things. Okay, if we quickly browse through, you can understand this. And now comes the more remembrance for starting with 40A. Starting with 40A. If tax is not deducted within that year or not remitted before 31st October, due date of filing return, 100% of the expenditure disallowed if the receiver is non-resident. 30% of the expenditure is disallowed if the receiver is resident. Is this clear? Okay. 100% of the expenditure will be disallowed if the receiver is a non-resident, and 30% will be disallowed if the receiver is a resident. Okay, resident. In the year in which it is rectified or proof is submitted, allow the disallowed portion. So that 30% or something which was disallowed will be allowed. Am I clear to you? Tax has to be deducted in the same year and remitted on or before the due date of filing returns. In that case, it is okay. If it is not, then this is the default provision. The provision itself is for ensuring that you are deducting the tax, and it is a disallowance provision. Am I clear to you? Okay. Okay. Remember, income tax, interest on income tax, penalty under income tax, okay, perquisite tax, and any other payment under this law is disallowed. Very much allowed, fully allowed. I'll come to that in a different place. 40B, interest and remuneration to partners. Interest and remuneration to partners. Interest at 12% per annum. Remuneration okay, based on book profit. Remuneration is based on book profit. In case of book loss or profit up to 3 lakhs, 90% of profit or rupees 1,50,000, whichever is higher, is allowed. On the balance, 60% is allowed. On the balance, 60% is allowed. And we just now saw interest and remuneration allowed is taxable to partners as business income. Okay. And I want you to remember this point. In case of presumptive computation, this cannot be claimed. Of course, any of the expenditure are deemed to have been allowed. Even this is. Suppose income is computed on a presumptive basis. 44 AD, 44 ADA, 44 AE. If income is computed, all the expenses under section 30 to 37, people feel 30 to 37 means 40B can be claimed. No, the law has been clarified. The law is clarified. No, 40B is a disallowance provision. Allowed is always 30 to 37. Even remuneration to partners cannot be claimed if you are following the 40B route. Okay, in excess of fair market value is disallowed. 40A subsection 3. Okay, on a single day to a particular person, if payment in excess of rupees 10,000 is made otherwise than by approved modes. Unapproved modes are cash, bearer check, and cross the check. Then whole of the payment is disallowed. Then whole of the payment is disallowed, not just the excess. The whole of the payment is disallowed. The whole of the payment is disallowed. Okay. Advertisement expenses 20,000. It is paid in cash. There is always a feeling that it could have been on 4 days. But what is the intention of the examiner is you should disallow it. You should disallow it. So whenever they say it's paid in cash, etc., ensure to disallow it. Ensure to disallow it. Okay. So some things like agricultural payments, fishermen, okay, no bank area, employees, temporary payment are allowed. Okay. And one more exception for resident goods transport operator, limit is 35,000 instead of 10,000. Limit is not 10,000, 35,000. Is the class clear? Okay. A follow by section is also important to the same extent. 40A 3A. What is that? Sir, in the financial year 22-23, I just made a provision. Salary account debit to outstanding salary 40,000. In the financial year 23-24, I am paying it by cash. The problem is, in the year provision is there, no violation. In the year violation is there, no expenditure. So the law said, where any preceding year expenses are paid in current year otherwise than by approved modes, then such payment will be treated as income. Are you clear? Are you clear? 40A subsection 7. 40A subsection 7. Payment to gratuity, provision for gratuity. 40A subsection 9. Okay. Payment to unrecognized funds. These all disallowed. These all disallowed. Am I clear to you? So far, am I clear to you? Now, going for this important provision of 43B. Going for this important provision of 43B. Okay. Look for a question this time on the second aspect I am speaking. Okay. Just now I saw the CMA inter question paper also testing on this. So let's understand. First part, second part. That is, the second part is that SME. Okay, that is a very promising questionable area. But let us first discuss about the first part. 43B, statutory payments. What are all the statutory payments? Okay, let us, okay, okay, any tax, cess, duty that is payable to government. Raja, this is what I said, GST provision. If GST is due but not paid, there is a disallowance. Normally, GST is not disallowed. It's not like income tax. Okay, but if GST is due but not paid, which has been debited to the P&L, then it will be composition scheme. You will directly debit it to the P&L. Okay, so taxes duty. Okay, employer contribution to RPF or any of the employees' funds. Employer contribution to RPF. Okay, bonus or commission payable to employees. Bonus or commission. Okay. Next is leave encashment. Interest to financial institutions and banks. Payment to Indian Railways. Okay, these are known as statutory payments. These are known as statutory payments. There are 6 statutory payments. Okay, this is A, B, C, D, E, F, 43B. That's why 43B subsection H is MSME, which we will see later. Okay, which we will see after this. What is the law is saying? Due on 31st March should be paid on or before due date of filing returns. Okay, due date being July or October, it should be paid before due date of filing returns. Not paid, unpaid amount is disallowed. Where it is not paid, my dear friends, where it is not paid, then the unpaid amount will be disallowed. Unpaid amount will be disallowed. Allowed in the year of actual payment. Allowed in the year of actual payment. Whenever, whatever is disallowed, whenever you are paying, that will be allowed. Is the class clear? Okay, this is with regard to these 6. Okay, I'm going to discuss little deeply because I want to put it in your mind how this entire thing works. Okay, now I am going to go to this category, which is a very promising questionable area. 43B subsection H, MSME payment. MSME payment. Okay, where there is, okay, where there is agreement. No agreement. Okay, where there is no agreement. Where there is no agreement, 15 days of transaction you should have paid. 15 days of transaction. Friends, one thing you have to be clear. This is only for outstanding as on 31st March. Suppose 1st March I am purchasing, no agreement. 1st March I am purchasing and 20th March I am paying. There is a violation. but no disallowance. Because even if you all disallow it, allow in the year of actual payment, which is also 23-24. Even if I have purchased it on 1st April 23, made the payment on 31st March 24. Violation is there, but there is no disallowance. So one thing in our mind we have to capture is, this is only if it is outstanding as on 31st March, I will verify this. If it is not outstanding on 31st March, if the violation is in between the year itself, if he is paying penalty, we will disallow it. But generally, as a provision, there is no disallowance. Even here I have said, due date, okay, due on 31st March. Similar here also, if it is due on 31st March only, you should look for this, okay, because the CMA question paper, 2 lakhs total purchase from MSME, for which they have to pay within 30 days. They purchased it on 1st Feb. 1 lakh is paid on 15th March. Another 1 lakh is paid on 15th April. Both are violation. But that first 1 lakh need not be disallowed. There is a violation. He has not paid within 30 days. But it is paid on 15th. The next 1 lakh should only be disallowed. Should only be disallowed. Is the class understanding? Okay. So what is due on 31st March? That is where you should check this 15 days or 45 days, etc. Where there is agreement. Okay. Where there is agreement. Okay. Date in agreement or 45 days of transaction, whichever is earlier. Whichever is earlier. Where there is violation. Okay. Remember, disallowed in the year of incurrence, allowed in the year of payment. Okay, only if there is a violation that is due on 31st March, only you should check. If it is paid before 31st March, on or before 31st March, even if there is a violation, leave the provision out. Look for due. So I will use the word MSME payment due on 31st March. So for that only this becomes important. If there is an internal violation, please leave it. Look for a question. It can be MCQ. It can be anything. Look for a question here. Am I clear? Okay. One other area of enormous caution, because our institute tests always is PF payment. There is an employee's part, there is an employer part. Provident fund payment. There is an employee's part, there is an employer's part. Okay, suppose Bala is my employee and I am deducting some 5,000 rupees from him. My 5,000. Together I have to contribute 10,000 to the Provident Fund account. My 5,000, I have time till 31st October. Due date of filing return. Employer's contribution to RPF, it has to be before due date of filing return. Bala's contribution, 15th of subsequent month. 15th of subsequent month. Where there is a default, it will be treated as income. Subsequent payment, deduction will not be allowed. Very important. January month's contribution. January month's PF contribution of Bala, I should deposit before February 15th. I deposited on March 1st. Sir, default is default. It is not like 43BH. Here, default is default. 5,000 rupees will be added to my income. Sir, I later paid. No, boss. This is not your money. It is employee's money. Please treat it with caution. Pay it before. Your money, I will give you time. But whereas employee's money, within the due date of the respective law, that is the PF law. So, employee's contribution need to be remitted on or before due date mentioned in respective law. That is 15th, my dear friends. In the respective law. Not remitted will be treated as income. Subsequent remittance expenses cannot be claimed. Subsequently, if you remit also, you cannot claim it as expenditure. Even within the year, even outside the year, you cannot claim it. Violation is a violation. The law sees this as a very strict offense because it is not your money you are playing with. It is a trust. Employee gave you that money thinking that you will deposit. So law is very stringent here. Whereas here need to be remitted on or before due date of filing returns. Not remitted, expenses disallowed. Okay, not remitted, expenses disallowed. Subsequent remittance expenses can be claimed. That is the difference. You're clear? You're clear? Please be careful about 43B. As I said, okay, there is possibility of questions. I'm not writing anything here because I have done that wholly. 43B. Okay. 41 is deemed income. Expenses allowed earlier, now recovered, or creditors foregone is income. Creditors foregoing is income. Bad debts recovered if it is allowed earlier. Scientific research assets sold. All these things will be treated as income. Am I clear to you? Okay. Then the most important next area is 44AB. Mandatory audit. Mandatory audit. Okay. Mandatory audit. Okay. Business exceeding 1 crore. Business assessees, if it exceeds 1 crore, you have to get your books audited. Okay. However, where cash receipt does not exceed 5% of total receipt, and which means both condition. Cash payment does not exceed 5% of total payment. 10 crores is the limit. 5 crore, okay. Cash payment. I never said only revenue expenditure. All cash payment should not exceed 5% of all cash payment. Okay. All cash receipt should not exceed 5% of total receipt. In that case, it will become 10 crores. 10 crores. Right? Okay. Profession exceeding 50 lakhs, you should get your books audited. Exceeding 50 lakhs, you should get your books audited. Pakka clear? Pakka clear? Okay. Now, again, one more questionable area, presumptive computation. Let's understand with the amendments that are there. Presumptive computation. 44 AD. Small business, okay, turnover not to exceed 5%. Turnover not to exceed, 2 crores. However, if the receipts otherwise than by approved modes does not exceed 5% of total receipt, 3 crores. Here payment condition is not there. Here payment condition is not there. Only receipt condition. Remember here the payment can be in any mode. If the receipt, you are maintaining 95% of the receipt in the bank mode, then it becomes 3 crores. One more extra crore, okay? And 8% of total turnover, okay? Turnover by approved modes, 6% only. Okay, most important, I'll work out some questions in the total income computation and show you, but this is most important, please remember. 44 ADA, okay, 44 ADA is about professionals. Gross receipt not to exceed 50 lakhs. However, where the receipt otherwise than by approved modes does not exceed 5% of total receipts, 75 lakhs. Okay, both the amendment, please remember, both the amendment can be questioned. Please remember. And 44 AE, flying off goods vehicle. Now vehicle only. For HCV, 12,000 kgs or more, ₹1 per kg per month or part thereof. Even one day will be taken as 1 month. For non-HCV, rupees 7,500 . This is what is PGBP for us. This is what is PGBP for us. Okay, friends. Okay. All of us has to remember one more thing. Okay. Okay. In the points to remember, I add this also, my dear friends, where, okay, we are claiming 10 AA, 35 AD or 80I. Anyhow, that is not there in our syllabus. Ensure to compute ATI and AMT. ATI, what is a ATI? Adjusted total income. Add back these things, reduce the depreciation for 35 AD and find out what is the tax. So if we are claiming 10 AA or 35 AD, okay, in our normal, you suppose the question will say 35 AD and say compute tax. That is where I want you all to be cautious. When you are computing tax, not only normal tax, you need to work out ATI and T. In a couple of questions we will work out, so that you are, if they say compute total income, you can stop with this. Compute tax means you have to obviously work. But be very sure, whenever they are questioning you on 10 AA and 35 AD, their point is also to question you on AMT. On AMT. Okay. Okay. So this also in our mind. About 10 AA, first 5 years 100% unit of a SEZ. First 5 years 100%, next 5 years 50%, balance 5 years 50% if transferred to reserve. Okay. Total profit into ET by TT. ET stands for export turnover, which is money received in India within 6 months. Not what is exported. Money received in India within 6 months is what is export turnover. Is the class clear? Is the class clear? Keep these things somewhere in the mind. When we do the solution, you will again, at that time I'll write and show you. As of now, keep it, put it in your mind. Okay, so that we are clear about it. Okay, right? Let's do a depreciation question straight away. Question number 1, page number 11. Rahul, engaged in the manufactures of chemicals, furnishes the following particular relating to his manufacturing unit in Morbi. Opening WDV, new machinery. New machinery purchased on 1st September, but put to use, that is the important date. If put to use not date is not given, then okay. Old machinery, compute depreciation. Four lakh into 7.5% plus 23 lakhs minus 4 lakhs into 15%. Read the next one. Mr. Piyush runs a sole proprietary firm and owns 4 machines which was put to use for business in March 22. The depreciation on these business was charged at 15%. The written down value was on opening WDB. 2 of the old machines were sold. A second-hand machine was purchased. Further, Mr. Piyush has furnished the following particulars relating to the payment made, expenditure towards scientific research, payment to an university, payment to a college. Compute the following for the assessment year. Depreciation, capital gains liable to tax, deduction available under section 35 if he has shifted out of the default tax region. How much is the value? 10 lakhs only, no? 2 of the old. Sorry. No, the form, the copy பண்ணாம formula அப்படி 28,500. That is 380 into 50, 7.5%. The last purchase, the asset will only be there. Okay, formula மாத்தாம விட்டேன். Want to switch it off. Yeah, tell me.
That just the time machine, he wants 4 missions. Then he sold only 2 missions.
We should not look at the number of missions. Block of asset method does not give us the benefit of looking at what is the value of individual missions. You cannot take that if 4 missions is equal to 7,70,000, 2 missions is equal to what, and it is sold for 10 lakhs. No, it's not. Block of asset is a format.
And already பழைய ஓல்ட் மிஷின்ஸ் இருக்குல்ல சார், அப்போ அதுக்கு ஃபுல் 15% கொடுக்கணும்.
But the value is not so. Unless this value is more than 6,10,000, I cannot give 15% for old. It's only a format. We don't have, our hands are tied. It's only a format. Clear? Okay. X and Co, a firm is engaged in the business of trading cloth. Turnover being 1 crore 57, out of which 25 lakhs has been received by account payee check. It wants to claim the following deduction: salary and interest to partners as per 40B, salary to employees, depreciation, cost of material, other expenses, total. So that 1 crore 42 and 157 is the income, net profit. Determine the net income of the assessment year, assuming that taxable interest income, LTCG, and the firm is eligible for 15,000 under 80G. For firm, there is nothing called alternative tax regime. Okay. The question is indirectly asking us, it's an exam question, I mean, it's a MTP question. The question is indirectly asking us something, whether they are right to maintain the books, or since the turnover is only 157, can I go under the 8% scheme? 8 and 6% scheme, presumptive computation, without maintaining books of accounts. Okay. Anyhow, the other incomes I can claim. Now we need to understand and give them a solution. Okay. So obviously it is better for him to go for 44 AD. Okay, obviously it is better for to go for 44 AD because the income is lesser and he need not maintain his books, get them audited, all these things. Anyhow, they have asked us to compute the total income. 2.5 days it should rain in Australia and somebody is paying. $48 for 4. It is just entered. And it's raining now. And somebody is praying there. 2.5 days it should rain. Okay.
Sir, in that P&L, if there is any disallowed, then we have to add it.
No,
Indirect.
no. Suppose I am going under 44 AD and they say that some 20,000 is paid in cash. I need not add back. 44 AD is a presumptive computation, not a book.
That's for book.
Yeah, you need to. Friends, can we continue tomorrow morning on this? Yeah. Okay. I'll continue at 6 o'clock tomorrow, 6:30 tomorrow morning. Yeah, 6:30 tomorrow morning. We will go complete all the chapters so that what will be pending is assessment of individuals. That I want to do it elaborately because it's a combination of all the chapters. Okay. Meet you tomorrow morning, 6:30. All the best, friends.